Hey, good to see you, my investor friends. This is Lucas here today. Now, in this video today, I want to talk to you about the 4 asset classes that are out there that you should be investing in if you want to be if you want your money to be making money for you. Now, that sounds a bit funny. Yes, we are always used to, we work for money. Like the moment you put in time, at the end of the month, you will be rewarded with money. Now, you got to see it like this. There are different ways to make money. Yes, the word says it. It's making money. And you don't always have to put in time to make money. There are also ways that your money can work for more money. Sounds very simple. In the end, it is. Well, I'll tell you this, okay? So in this video, I'm going to talk about those 4 asset classes that are out there that you should be using if you want to start making money on this money market business. Now, of course, there are different ways the moment you start making your first millions. Yes, there are other classes out there that you should be investing in as well. But hey, most likely, if you're in that business, you're not going to watch this video with me. Okay, so let me get to those 4 asset classes that we're going to talk about that you could apply right away to make your first dollars, to make more money out of that. And the first asset class that I want to talk about is, of course, equity. Now, equity, we're actually talking about stocks, okay? So what you do is the moment you trade in certain, your money for a certain share within a company, it's very simple. It grows over time. Now, for example, if a certain company, they issue about 1,000 shares, let's say they issue 1,000 shares. So they issue 1,000 shares in their company. And so companies do this to gather money, of course. They would say, you know what, I've got 1,000 shares, and if you want to own a part of my company, go buy my company shares. You could do that. So the moment my company or this company starts to make money and they start to create more and generate more value over time, what happens is those shares also grow in amounts of money. And then, your equity would grow over time as well. Okay? So the moment a company issues 1,000 shares, and you tend to buy up 100 shares, for example, this would mean that you would own 10% of their company. And the moment they make a certain percentage, so they make a certain revenue or a certain profit, then you would get a 10% of that profit, of course. That's the whole idea behind stocks. And this is, of course, if you buy into one company. Now, if you buy into one company, stocks work very simple. For example, if you would check out Apple, they would ask you maybe $250 for one share. And of course, Apple has over millions of shares out there. And that's the whole idea. But if you don't want to do it like that, there are also different ways. There are also stocks that you could buy dividend. And I've talked about this before in different videos, of course. Dividend is, instead of you're owning them something, you're buying a stock that pays you out monthly, quarterly, or annually. They'll pay you out because you own a part of their company. The moment you buy a dividend stock, what you do is they're not going to give it back to you in equity. They're going to give it back to you as an income. Every quarter or every month or every year, they're going to pay you a certain amount. They're going to pay you their dividend. So if they would make, this could be somewhere between 5 or 10%, depending on what kind of company it is, of course, and kind of stock that you're buying into. Now, there's also a different way, of course, and this is what I like very much, is the moment you buy a certain stock, you have to buy it per share. You can't buy half a share. The moment you want to do that, because you want to buy on your terms, that's what they call sometimes like a fund. So what you do is you buy into a fund, and that fund has selected, well, most of the cases, about 90 companies. And in those funds, there's a fund manager that keeps track of all those companies. And you buy into the portfolio of that fund manager. And that guy is taking care of all those companies and all those shares into that. And then you would own a share, or you would own a piece of that whole fund. And the fund, of course, tracks the index, and that's the way how you make money. Now, how to get started within the equity market, within the stock market? Of course, you need something called a brokerage account. Now, I don't know in your company, but in your country, in my country, in the Netherlands, we also call these investment bank accounts. So I've got something. I've got two investment bank accounts. I've got the Giro on the one end, and on the other end, of course, the big bank. But any major bank account in the world, and major banks offer this service already, like a brokerage account. The only thing is, the brokerage account helps you to buy certain stocks using the account that they have within their bank. And it's a very easy way. Of course, you can select like, hey, you know what, I want to buy into a certain index, for example, the S&P 500, or you want to buy directly from certain companies, for example, saying like, you know what, I want to buy Apple, or I want to buy Tesla stocks. That's what you could do, and these brokerage accounts offer that service to you, of course. So that's the first one, equity. I love it very much because I use these so much every month, and I even teach a course within this, how to grow your own money, of course, and the course is also called How to Grow Your Money, because in the end, you're putting in money, and the money will work by itself using a certain formula. Okay. The second one, of course, is called bonds. And bonds is actually a different way of telling it, because you're investing in people's debt. It's very simple. The idea is rather simple. The idea what you do is, you use the same brokerage account for this. What you do is you buy a certain bond, in this case, instead of a stock. What you do is you get a piece of paper, meaning it's an IOU paper. It's a loaning paper. You loan people money. And the IOU actually tells you how much percentage you would get by the end of the year. Most of the time, they pay out once a year. And of course, they also tell you when is the end date. The moment it reaches the end date, that's the end of the whole bond that you've gotten. Now, you gotta see like this. Bonds are actually loans, whereas equity, you actually own a piece, you own a share of that certain company. Now, within the bonds, so the moment you go into the debt, you go into debt investing, what happens is you get a certain piece of paper, of course, and with that paper, you got to see like this. There are governments that issue bonds saying like, you know what, we need an infrastructure project that needs $30 million, and for that 30 million, we're gonna issue these bond papers, and then you can invest in these. And what happens is, of course, when a government issues these bonds, most likely what happens is the payout is rather 99% that's going to happen. You got to see like this. Bonds are good, but the thing is, with bonds, the return of bonds is somewhere between maybe 2, maybe 3%, which is not that much, because you got to think like this. Inflation is about 2% per year. Inflation grows about 2%, on average 2% per year. So the moment you get somewhere between 2 and 3% as a return on investment, bonds in that case are not that very interesting for the long term. So if you're someone like me, like you're somewhere in your 20s or your 30s, you don't really want to go into bonds, because yes, they are safe. I get that. Yes, you will get your investment back at the end of the timeline, of course, with interest. But the moment you want to make money, you really want to have money grow over time, equity is really your friend. And equity could get you somewhere between 7 and, this is safe investing, somewhere between 7 and 12%. If you're really good in an equity investing in stocks, you could either go over 15%. But that's for those people who are really good and know what they're doing. Because in bonds, you don't really need a certain strategy. The only thing that you need to do is to do your due diligence. You really should know if these companies are credit worthy, because, there are bonds out there, which are most likely corporate bonds, that they say, you know what, we need a certain loan, we need maybe $10 million and to invest in our company, and it's a loan. You don't get, it's not a share, but it's a loan. So you're gonna give us money, we'll pay you back, we'll pay you back the principal, and we'll pay you back the interest. And with that, you'll see these bonds, these are corporate bonds. So these corporate bonds, what you will notice in most cases, they'll be, 3% or up. And if you even go further, you'll sometimes see even 12%, and those are called junk bonds. There's a reason why people tend to call them junk bonds, because, well, maybe the word says it, junk. The thing is, the credit worthiness of these corporations, of these companies, is slightly lower, and therefore, hey, nobody's going to invest in them, nobody's going to loan them money, so therefore they have to give people a higher return. And with that, the chance of these, these projects to go bankrupt or these projects to fail is bigger, of course, and therefore the return is also higher, so that they will interest people like, hey, you know what? It's not a government bond, it's a corporate bond, and I don't know if this project's going to work out, but I'll give you 12% return on investment. That'll pull the trigger for some investors, saying like, you know what? Although it's a bit risky, hey, I get 12% return. I don't have to do anything for it. So it's not too bad. So this way, it's also a way to attract clients and people and investors to invest in those projects of bonds. So that's the second way, bonds. And you're actually you don't have equity, you don't own something of their company, you just loan people money. Now, the third one, and I love this one very much as well, this is the real estate. Real estate is kind of the next step, because why is this the next step after investing in equity? Well, the starting point, what you normally see very often, is about tens of thousands of dollars already, because you can't really buy real estate for $1,000. And yet, that is not true as well, because there is something called, I'll write it with blue. It's called the rate, which is the real estate investment trust. What happens is, these are companies, publicly traded companies. What they do is they gather your money, so they take your money as an investor, and with that money, they will buy into real estate. That's what they call the real estate investment trust. That's what they do. Yeah. So they invest in apartments, but they also invest. So these are bigger projects within real estate. And what happens is, you buy a share within those projects. So these are these platforms that they say, you know what, we're going to invest in a, maybe 40 apartment building. And we need maybe $40 million. And for that, who would like to invest in this project? And then all of a sudden you could say, like, you know what, I'll invest in these companies. Making this completely passive, because, the only thing what you do is you invest your money with them in these REITs. And what happens is, they will invest in those companies. They will invest in those real estate for you. So there's no need to have, headaches about tenants, or if there's a toilet that is broken or anything, or, rent that is not covered or anything. They will take care of all the things. And what you will see with these REITs, of course, they will be, what you see very often is they have a return on investment around 7% already. But see, like this, hey, the moment you give out the control, what happens very often is that you give a lot of way of money as well, because what happens is they will charge you fees for that. Now, real estate on itself, of course, this is the interesting part. If you do have the money, and I'll write this with a different color for you. So the moment you do have your own money, let's pretend that you have your 30K to invest in real estate. You can already, this is the interesting thing about real estate. With a certain amount of money, what you could do is you could leverage this amount of money. This is the only asset class of the 4 that I'm going to talk about. Number 4 is going to come in a bit. Of all the asset classes that are out there, real estate is the only one that you can leverage. And what does leverage mean? Now, in this case, in equity, you need to put in your own money. Bonds, same idea, only your own money. Real estate, on the other hand, the bank will loan you money, will say, you know what? Hey, you're doing a great job here. Here's some money. And this is the great part. This is what they normally do. This is about 30% should be your own money. And 70% the bank says, you know what, you'll get free money from me to invest in a certain real estate project, or your whole idea. The whole idea of real estate is that you can leverage your money. And by leveraging the money, all of a sudden, you can use free money from the government, which is not completely free because you still have to pay interest, but you get money for free from the bank to buy real estate. And with the real estate, you can take in rental money. It also grows equity over time, because you could buy a certain apartment for $100K right now, and if you would sell it off in 20 years' time, maybe it's 120 or maybe 130,000 bucks all of a sudden, because that's what real estate does. It grows in value over time. And of course, at the same time, you can actually just take in rent from those tenants that live in your home. And if you don't like that as well, you can put a real estate agent in between, and they will take care of all the headaches, things that you don't like. And all of a sudden, you could be charging, you can be getting, and this is cash flow. You could be getting cash flow somewhere between 4 and 12%. This is the cash flow, 4 to 12%. I'm not talking about equity gain, because you still get equity gain as well. Over time, the property gets more worth as well. The moment you sell, you get the equity gain as well. And that's the cool part about real estate, because you can leverage and you get equity gain as well. So there are double things up on top of maybe the 12% that you get. Whereas in investing in stocks, you do get the equity gain, but it doesn't grow that fast. And it's besides, buying into real estate is kind of tangible, because the moment you would want to see the real estate that you purchase, you can actually just travel there and see the home or the office that you bought. You can actually touch it if you really want to. Whereas going into stocks, you can't really touch it. It's digital. That's the whole idea. Okay, let me quickly go to the last asset class, which is the class called cash. Yes, cash is also investment. You could be investing in cash and cash equivalents. Now, for me, this is actually just parking your money on a short term. See, you got to see it like this. There are ways that you can park your money, for example, in a certificate of deposit. All of a sudden, you would put your money away in a certain place. And what happens is, it's a very easy way, it's a very liquid way to put your money somewhere, keep it safe, because, leaving it on a bank account doesn't generate you anything with a current bank interest rates of 0.05% maybe, so that doesn't do anything. But you could park your money in these cash equivalents. What you could do, for example, and you don't have to leave your tens of thousands of dollars that you have lying around. If you don't use it, you can put it on a certain savings account that will give you maybe somewhere between 1 to 2%. And what you see very often is that if you put these on a cash equivalent place, for example, these CDs, is that you have to leave it in for example, like 90 days. Because, hey, you got to put something on the other end, of course, a little bit of your time. But in most cases, this is short term, doesn't grow your money over time. And like I said, inflation is around 2% on average, making this completely dead. That's why I always say, money is dead. Money is a bad investment. Money doesn't do anything. So investing in cash equivalents, it's an okay place if you just want to park your money for just a while. The word even says it. You park your car. You just park your money for a short term. You're going to leave it there for just a while to keep it safe. The moment you need it, you take it out right away. That's the whole idea. And it's, not too bad if you get somewhere between 1 and 2%. It's not too bad, but is it something for the long term? Absolutely not, because inflation will catch up with you, and then you'll just lose the whole value of cash. And this is the 4 asset classes that I want to talk about today, and you should be investing in these as well. And I'll tell you this, investing in equity, absolutely something that I really love very much. Investing in bonds, now in my case, I do have a few bonds stock that I have, of course. Is it something that I'm favorable about? No, not really. But hey, you got to try something out, and you got to spread your chances as well. Real estate is something that I love very much, because I've been doing this for many years already myself. And it's a real good way to see equity grow over time as well. And I'll tell you this, just the other day, there was one of my tenants that said, Lucas, hey, I'm interested in buying this property from you. Is that okay? Now, this person has been living in my property for, I think, 4 or 5 years already. And this person said, I know that it's going to cost me, but everything is going to be cheaper than the rent that I'm paying already. You got to see like this, people sometimes pay like $900 on rent. The moment you would buy the property, you would only have to pay the taxes and such, but all of a sudden the mortgage would go down, even though they would pay a lot more money by buying the bank, right? By buying the property right now, because the bank gives you money for buying the property, and that's all of a sudden super nice. I think the person is paying like $600 per month right now, mortgage wise. It's like, hey, that $300 was my profit per month, next to the equity gain. But the equity gain gave me already, I think like the equity gain itself already only gave me like 5% per year. So owning that property for 6 years already gave me in total, well, 6 times 5%, which is not bad, next to all the rent that I got already. So yes, at real estate, if you would be able to go into real estate, absolutely do so. And the last one, cash. Yes, I also have cash lying around. And the moment I have cash lying around, what I do is I invest in these cash equivalents so that I don't lose the money by leaving it dead on my bank account. And this is the 4 that I wanted to discuss with you. Yes, there are bigger things out there like hedge funds and such, but hey, those are the things that for real people who make real serious money. And most likely, like I said, when you're watching this video with me here, you're not in that area yet, but that's okay. If you're interested, you can always reach out to me personally. If you like this course, of course, if you like all the stuff that I'm talking about, if you're interested in the course that I'm offering within the equities, be sure to check me out on lukasshoe.com/GYM. Grow your money. Go check that out. Hey, thank you very much for watching this video, of course. If you haven't subscribed to the channel, be sure to subscribe and hit that subscribe button. Thank you very much, and I'll see you on the next video. Happy investing. Bye-bye.